And welcome to the Retire Early, Retire Now podcast. I am your host, Hunter Kelly, owner of Palm Valley Wealth Management. And today we will be talking about Roth conversions and how they can give you long-term tax flexibility as a advanced tax planning tool or strategy. And so we talked a little bit about these last week and some previous podcast episodes as well. I wanted to dive back into these because generally most people are considering these Roth conversions right about now. So make sure you check with your custodian to make sure that if you are considering or Roth conversions, you know exactly the date that you need to submit that request or that paperwork and how that's done. Because the last thing you want to do is try to get that paperwork in and then it's too late. And then you miss the cutoff for 2024. So make sure that you're looking at that. I know we're coming in to the end of the year pretty quickly, but this can be a great strategy to give you tax flexibility and control throughout the rest of your life, and hopefully also save you quite a bit on your lifetime tax liability. We talk about that a lot, especially for high income earners. This will be your largest expense over your life. So do what you can, do the research, work with professionals to minimize this so that you can keep it in your pocket and do the things that you want to do with it, whether that be spend it, give it to your kids, give it to other family members, charity, whatever that may be. You have ultimate control over it, ultimate flexibility, and that's kind of what this podcast is about today. But before we jump in, just as a reminder, I'm starting to record these and put these on YouTube. So go into YouTube and give me a like, subscribe to my channel, and share this with a friend. Again, anything to save taxes or plan for taxes can be very helpful to most people. So if you think someone could benefit from this topic, go ahead and share that with your friend, and it would be greatly appreciated. But let's hop into Roth conversions and how they're used as a tool. So hopefully by the end of this episode, you'll understand what a Roth conversion is, why it might make sense for your situation, and how it fits into your broader financial plan. And then lastly, navigate any pitfalls or gotchas that come along with Roth conversions, because there are a few, but if you navigate them properly, they should be no problem at all. So let's hop into what a Roth conversion is. Converting pre-taxed retirement funds, so that can be traditional IRAs, pre-tax 401ks, rollovers, things of that nature, to a Roth account. So you're basically transferring that money from that pre-tax account to the Roth account, paying taxes on that, and then that money will be after tax dollars. It will grow tax-free, and as long as it's a qualifying distribution later on down the road, it will be tax-free. So that will obviously be a benefit later on down the road, and could potentially, if you time these properly, could potentially save you in taxes as well. And so why would we want to consider Roth conversions? Well, it can do a couple of different things. One, it can create tax diversity in the types of money that you have and types of assets that you have. So we talk about the 3-bucket strategy a lot on this podcast. And this is one way to kind of build that third bucket, right? So you have your after-tax dollars, your brokerage accounts, things of that nature. You have your pre-tax dollars from 401ks, traditional IRAs, SEP IRAs, whatever that may be for you. And then you have your Roth money as well. And so utilizing that 3-bucket approach can give you some more tax flexibility and tax diversity as you move forward. And so 2 ways to do that would be either to contribute to your Roth IRA or Roth 401ks, or do it through Roth conversions. And so depending on your situation, one could be more appropriate than the other, or both. It just depends on your situation. So the second thing why you would want to consider it, obviously I mentioned this before, but tax flexibility, future flexibility. Once those funds are in Roth, future qualified withdrawals are generally tax-free. So this could be your large purchase account later on in retirement. It could be a legacy play where now you've kind of taken on that tax burden, and your kids and your heirs will not have to pay taxes on that money. It could be used for long-term care purposes, whatever that may be for your specific situation. But it can give you that flexibility. It could supplement income and keep you at a lower tax rate, maybe avoiding Medicare surcharges, things of that nature, right? And then the last thing for a lot of high income earners, it will minimize your required minimum distributions later on down the road. So again, it will help you control your taxable income in retirement. And that's the biggest thing or the biggest perk that I see for most clients that I work with is over time, we will end up minimizing these RMDs, which will minimize their taxes over their lifetime. And sometimes it can save them hundreds of thousands of dollars in taxes, depending on their situation, right? So these are a couple of reasons, 3 reasons why we would want to consider Roth conversions and what Roth conversions are. And so the next thing we want to think about is key factors and that we need to consider before converting. So what do we want to think about before we make the decision to convert our pre-tax dollars to Roth dollars? So obviously tax rates are something that you want to consider. So what are your current tax rates and what are your future tax rates going to be? So assess your current marginal tax bracket. So are you in the 22% bracket, 24% bracket, 35% bracket? Where are you in your income bracket or your highest income bracket? And then where do you think you're going to be in the future, whether that be before retirement age, after retirement age? Do you have a large sum of income coming in for a few years and then it dramatically drops because of retirement or you selling a business or going PRN, whatever that may be? What does now look like and what does the future look like, right? And then what do you expect those new rates to be? And then obviously you want to take into account any legislative changes, so any tax changes coming from Congress, things of that nature. But generally, your own situation is probably going to change that more dramatically. So timeline and retirement goals is the next thing you want to consider. So the longer the time horizon that you have to need these funds, the more powerful this strategy will be. So for my early retirees, say 55 or younger, this strategy would be the best for, right? Because they have a long time that they can kind of let this money grow, right? So if you are retiring at 65 or 70, something like that, yes, you still should consider this, but your objective and the amount of growth that you should expect from this type of strategy would be minimized relative to someone that is retired at 50 and has 20, 30 years to kind of let this grow and reap the benefits of, right? So for early retirees, Roth conversions can be kind of a multi-year strategy. So it's something that we're going to look at and analyze every year. And then one of the purposes of doing that could be a legacy play and kind of the other things that we talked about here that we'll kind of dwell on here in just a second. The next thing you want to consider is your cash flow for tax conversions. So paying the taxes due from a non-retirement account is ideal. This will help you maximize it. So if you're going to convert $50,000, then you would want to take money from either savings or an after-tax account and pay those taxes that are due on the $50,000 that you converted. So let's say your marginal tax bracket is 22% and you convert $50,000. Obviously, you're going to owe about $12,000 in taxes on that conversion. So how do you want to pay that, right? And so the options are you can withhold or you can pay that from out of pocket. Obviously, you want to keep the most money invested over a long period of time. That's going to work out best mathematically. But if you don't have the liquidity to pay for those taxes up front, one, you want to kind of rerun that cost benefit analysis there. But two, if it still works out in your favor, you can withhold from that account that you're converting from and pay those taxes then. The next thing you want to consider is some Roth conversion scenarios. So, when is a good time to do the Roth conversion? When does it make sense? And so, what are some strategies involved with that? And so, the first thing that we look at is bracket management, right? So, where's your marginal tax bracket? How far are we from that next bracket up? So a lot of times we will convert to fill up to that next bracket before you kind of hit, let's say you're at the 22% and you have $20,000 to go. Sometimes we may convert that $20,000 to keep you in that 22% tax bracket, right? Coordinating with other income sources. So we want to take into account bonuses, rental income, capital gains, things of that nature. So all of these things that we want to consider. And generally, when we run these scenarios, a lot of times it'll look like a bell curve for how fruitful they are, right? So you convert a little bit, you're going to see a little bit of maybe tax savings or long-term growth added to your net worth over time. And as you convert more, you'll see more and more benefit. And then eventually, you'll start converting, quote unquote, too much. And then the taxes that you have to pay up front will start to negate some of that benefit of doing the conversion. So generally looks like a bell curve. So we want to find that sweet spot. And that's something that we'll analyze on a yearly basis based off your income, based off tax rates, things of that nature, to make sure that we're kind of maximizing that each year. It's not a set and forget type of deal. The other thing you want to consider, obviously, early retirement window for those who retire in their 50s. You won't necessarily take Social Security for potentially 10, 15, 20 years, depending on how early you retire and when you want to take. And so the biggest thing that this is going to allow you to do is do a long conversion ladder. So you can actually convert a little bit less and keep that tax rate much lower. And then this will minimize your RMDs later on down the road. And then obviously give you quite a bit in Roth money moving forward. So whether you want to use that for your retirement or passing down to your heirs, whatever that may be, right? And that's kind of what I want to transition to now. And the other thing that you want to consider is your estate planning angle, right? So if you are kind of just a typical retirement age, 60 to 65, potentially 70, these Roth conversions still may make sense for you, right? And the reason why I say that is if one of your goals is to pass this down to your children, then it may make sense because maybe you think you're going to live to 85, 90 years old. This money would continue to grow for that amount of time. And you know that, hey, I won't touch it. And this can be something my kids will be able to benefit from and not have to pay taxes on, right? And so this is actually a conversation I had with a client a few weeks ago. They have enough money for them to live the retirement that they want and then some, and still be able to grow their net worth over time, right? And so they could come back to me and say, hey, we want to spend every dime, right? We want to be left with one penny. And that would be great. That'd be awesome. Let's change your spending habits. Let's increase your spending, so on and so forth. But their goal is to be able to leave some of this money or a significant amount of this money to their children. And one of the best ways to do that in their situation is do some of these Roth conversions now so that they have a very large chunk to give to their son and daughter, and they won't ever have to pay taxes on it, or at least for the 10-year window before they have to get that money out of the account. So this is a great way to kind of show a legacy play or pass money down to your heirs, right? And so let's transition into coordinating with other strategies. So how does Roth conversions pair with other types of tax saving strategies, right? And so often one that I'll use, again, a client that I've been working with the last couple of months because he's preparing for retirement. So we're going to coordinate Roth conversions with what's called net unrealized appreciation, right? And so So one, what is net unrealized appreciation? It's a little bit of a tangent, but I need to explain it before we can kind of get into the strategy. So this is where you have some sort of concentrated, publicly traded stock inside of your 401k, right? And let's say you bought that stock over the years, whether it is gifted to you from the company or you bought it through your 401k plan itself, and you paid $100,000 for the stock, right? But the stock is worth $500,000. Well, what NUA will allow you to do is transfer that stock out to a brokerage account. You'll pay taxes on your basis. So the $100,000 that you bought the stock for, and then moving forward, any gains that you have would be taxed at a capital gains rate. So if your tax bracket is going to be at the 22, 24, 20, or 24 or higher, right? As the tax laws stand now, you're going to benefit from a lower capital gains rate than you will that ordinary income rate as you start to take distributions. So you can see the advantage here. Taking this $500,000 out, paying taxes on the basis as you move it out versus taking this $500,000 out over time at a 22, 24, 30 something percent marginal tax bracket, whereas capital gains rates are somewhere between 0, depending on your income, or 15 to 20%, right? And so this is a great way to kind of save taxes. So how do we coordinate this with Roth conversions, right? And so let me find my notes here. So step one, right? We want to isolate and distribute the company stock, right? Just as I talked about. So before we begin Roth conversions, we want to consider the NUA strategy on your company stock by moving these shares from the tax deferred account, so the 401k account, into a taxable account to effectively remove any potential large portion of your retirement assets as ordinary income, right? So we can save on those taxes. Step two, we want to lower your pre-tax retirement account balances, right? So that is the goal, right? So in the case of my client, his ultimate goal is one, to save on taxes, but two, be able to pass down a large portion of his net worth to his kids on a tax-free basis. So one, they'll get a stepped up basis on this new stock that he's transferring over to this brokerage account that he had in his 401k. And then step two, once the company stock has been distributed via NUA, the remaining pre-tax funds can be systematically converted. So each year we're going to look at his tax bracket, what his income is going to look like for that year, and then we're going to make some sort of conversion to keep his taxes manageable over time. And so timing is everything. So for example, the NUA distribution is executed in a year where you have low income, right? So hopefully the year after he retires, he'll have much lower income. And then we can convert that because now his ordinary income tax would be much lower than what it is right now while he's working. And so from there, we can start doing those conversions as well. So probably the year after, because he has about $100,000 of taxable income from that NUA conversion, he will pay that taxes, and in the following year, we can start those conversions. And so over time, what this is going to do, one, he'll be able to pay long-term capital gains on any transactions that he has by selling that employer stock. And then two, he will reduce his RMD moving forward every time we do those conversions. So more and more of that money will become Roth money. And so for him, that's going to save him hundreds of thousands of dollars in taxes over his lifetime, increasing his net worth, hopefully and potentially in the millions, right? And so obviously things can change, tax rates can change, laws can change. Maybe we don't get the expected return that we project and things of that nature. So all of this is kind of just a plan, and we'll reassess that every year to maximize it as much as we can. But as it stands now, this is a great strategy in how you can pair Roth conversions with other tax saving strategies, right? And so let's see here. So let's talk about some potential drawbacks or pitfalls that you want to watch out for, right? So the tax bill shock, right? So if you don't plan on how you're going to pay for these conversions, the taxes on these conversions, because remember, if you convert 50,000, that's $50,000 of income. So how am I going to pay my potential $10,000 to $12,000 tax bill? Am I going to withhold it from my traditional IRA that I just converted from, or am I going to pay for it out of pocket? So don't get shocked with that tax bill moving forward. And if you're under the age of 59, anything, or 59 and a half, anything that you withhold will be counted as a distribution. So then you potentially have some penalties there, which again, as long as you run that through the cost benefit analysis there, if it still makes sense, maybe you still do the conversion, or you take less of a withholding and pay a little bit out of pocket, things of that nature. So you can kind of finagle that a little bit, but beware of the taxes. The other thing that a lot of people don't consider, especially as they do these conversions close to 59 and a half, is the 5-year rule on Roth IRAs. So you have to have the money in that Roth IRA for 5 years or 59 and a half, whatever comes last. So if you're 58 and you don't have a Roth IRA, but you open one up and you do conversions to get some of that money in there, you got to wait 5 years, 5 tax years before you can start taking that money out as a qualified distribution. Now, you would have access to the contribution or the conversion that you've already paid taxes on, but just be aware that any growth there would be subject to that 10% penalty and taxes if you don't wait that full 5 years. So just keep that in mind. The other thing is state tax considerations. So if you live in a state where there is state taxes, fortunately I live in Florida, so I don't have to worry about that with most of my clients, but you do want to plan for those state taxes. And then market timing, right? So obviously it would be more beneficial to convert on a market downturn, right? Because then technically you're converting more shares at a lower cost. But just be careful of trying to time the market like any other type of investing strategy. We don't want to time the market. We want to have more time in the market, right? So come up with a plan, stick to the plan. If you happen to have opportunities to convert at a much lower rate, take advantage of that, but don't have the plan of, I'm just going to wait until the market pulls back 20%, because that may never happen, right? Or 50% or whatever, or it may take 10, 15 years to happen, right? And then you could have been converting along the way. So have a plan, stick with the plan. Now, what are some practical tips to implement these types of strategies? One, and the obvious one, is work with a financial planner or a CPA that is experienced with Roth conversions and other tax saving strategies. Again, talk about a lot about tax planning. Don't go to your tax preparer about these types of strategies if they're not doing tax planning for you. Tax preparation and tax planning are two different things. You want someone that has experience with tax planning. So someone that is going to look forward in your financial situation and help with these strategies, right? So again, work with a financial planner, work with a CPA that does tax planning that can help you with these strategies. Plan out a multi-year timeline. So we want to have a plan in place, especially for these Roth conversions. How much are we going to convert or make sense to convert over a 5 or 10-year period? But we also want to take a look at that each year, because your situation may change year to year. The tax rates may change every so often. So we want to take a look at that plan and reassess that plan every year, but have a long-term plan in place for some of these Roth conversions if that is one of the strategies that makes sense for you, right? And then obviously consider your state taxes and future plans to potentially move. So if you're retiring and you live in Florida and you want to move to Alabama, you're going to have state income tax. So how does that change your plan, if at all, right? And so how does the Palm Valley pathway. And so I mentioned this process a little bit before in a couple of other episodes. How does Palm Valley Wealth Management work and help in these situations where Roth conversions could and would make sense for their clients or potential clients, right? And so, first thing we're going to do is we're going to organize and look at all of your retirement accounts and their tax characteristics. Do you have the 3-bucket approach, or do you only have pre-tax, or you only have after-tax, or you only have Roth? What does that look like? And how do we assess that and get a good, clear picture, right? And then once we have an idea of what that situation looks like, we'll optimize it. We'll run multiple tax projections from our financial planning software and our tax planning software to make sure that conversions make sense for you. So if it's something that we think is going to make sense, then we'll run those projections and see kind of where your sweet spot is. How much should we convert? How long should we convert it? What does that look like? Because remember, it looks like a bell curve, right? So 20,000 may look good, but 50 may look better and 75 may look worse. So where can we find that sweet spot of how much we want to convert on a yearly basis? And then we'll bring that plan back to you, incorporate the conversions into your overall financial plan and how that works with everything else and your goals. So whether that be a legacy play or just giving you tax flexibility later on down the road, saving on taxes, things of that nature. And then we'll help you execute, right? So it's easy to come up with the plan. Implementation is not always the easiest part. Sometimes it's the hardest part, right? So how do we get with our custodian to convert these things and monitor them and adjust them year over year as things change, right? And so that's part of the Palm Valley pathway. That's what I do for my clients. So if it's something where you listen to this podcast, I really think that Roth conversions would make sense for me, go to my website, palmvalleywm.com, and I can schedule a free call with you and we can kind of have that conversation and see if that makes sense for you. And so I appreciate everyone listening. Again, share this with a friend. Go to YouTube, like my YouTube page, subscribe to it, leave a 5-star review on your favorite podcasting app. As this grows, I want to be able to help more and more people save on taxes, get more money into Roth, reach their financial goals. And this is kind of just the starting point to that. And so next week, we'll kind of dive into charitable giving tactics that kind of complement Roth strategies for maximizing charitable giving. I think this is a good lead up to the Christmas and Hanukkah holiday. You're maybe in the giving mood, so I think having a episode on charitable giving would be a great kind of seasonal thing. But I appreciate you guys listening. Again, share this with a friend, and we'll see you in the next one. This podcast is for educational purposes only. It is not meant to be financial or investment advice or tax advice. Please seek a financial planning professional, tax professional, legal professional when considering your own situation. Do not make decisions solely based on this podcast alone. Please seek help and please keep Palm Valley Wealth Management in mind when making those considerations.